this program is put on by Myron Scholes. I'm actually going to talk about the analysis of the macro situation in Japan. Then I'm going to talk a little bit about how it's priced and how I think it's the most interesting option I've ever seen in my entire life. And Scholes is part of the calculation. So let's get into just a few things that we're going to talk about: anatomy of the zombie economy, demographics, catalysts, and conclusions. When you talk about 2 lost decades in Japan, I don't know, some people refer to it as 1. You know, I count the years, it looks like 20 to me. But when you get to looking at the Nikkei in blue and nominal GDP in red there, it shows you that we're back to where we were in nominal GDP, you know, over 20 years ago. The Nikkei's fallen by about 75% peak to trough, sometimes a little bit more. Real estate's fallen by about 75% peak to trough. And tax receipts look very similar to nominal GDP. We all know what the central government debt as a percentage of GDP is. I actually think the more relevant metrics to use are multiples of central government tax revenue. I'll get into that. Just to put things into perspective, Japan crossed 1 quadrillion yen of government debt, and for those of you at home, that's 1,000 trillion yen. If you tried to count to a quadrillion and you only assumed each number took 1 second to orate, it would take you 31 million years to get there. So this is how ridiculous we have finally gotten to as Spaceballs, the ludicrous level of debt in Japan. Something is really important. One of the things that we focus on at Heyman and something I focus on with debt sustainability is thinking about when you sail in that zone of insolvency. And many of the white papers written on this subject really focus a lot on emerging economies, because very few developed economies have actually had to restructure. So in the emerging economies, what kind of the common denominator for time to restructure is when your debts get to be roughly 5 times your central government tax revenue. I would argue in a developed country, clearly you borrow at lower rates, you can finance more debt that way. The number's a little higher in the developed world. But the top chart is a dual-axis chart that I think that we need to pay a lot of attention to. The blue bars are incremental JGB issuance annually. The red line is just the interest check that the government of Japan writes to investors. The bottom chart here is basically the whole interest rate regime across the board. So what you see is Japan really went to a full zero in the middle of 2001. For all intents and purposes, in the discount rate, it went to a 0 or 0.5% in 96. What you see is as Japan from 98 to roughly 2005 issued more debt than it had ever issued in its history on an annual basis, their interest costs were still plummeting because it takes a while to refi the capital stack as debt comes due. The point I'm trying to make here is when you see the fact that, oh, and by the way, the reason that line has a right angle, the red line, these are their estimates, not mine, just to put things into perspective. You see that even though they're continuing to issue more and more and more debt, what you're seeing now is their expenditure for interest has moved up to almost 11 trillion yen. It's about 10.5 trillion yen. To put that into perspective, their central government tax revenues are roughly 43 trillion yen. So they spend a quarter of their tax revenue on interest alone today, and that's when it's free. 5-year bonds are, what, 17, 20 basis points? I mean, this is zone of insolvency. There's no looking back. When you understand what this chart's telling you, they've already passed the zone of insolvency. And what's important to think about is Japanese debt stock is about 24 times central government tax revenue. So if Abe and Kuroda and the team and also get into really achieving some kind of inflationary outcome and the swaps move, they're finished. Right? If every 100 basis points of cost of capital to the country costs them another 11 trillion yen, a 200 basis point move has their debt service exceeding central government tax revenue. That's how bad it is. Those people wishing for inflation in Japan know not what they wish for, in my opinion. So this is something Austin and I were talking about beforehand. Back in 1990, the peak level of tax revenue the government ever brought in, back when the Imperial Palace was worth more than all of Canada, was about 60 trillion yen. If you see, there have been fits and starts throughout the time period here, but basically they're right around 40 trillion yen of tax receipts, and you see total expenditures, and by the way, their numbers, not ours. These are not supplemental budget numbers. These are initial budget numbers, which they change 4 or 5 times throughout the year. That for the 5th year in a row, they're going to spend more than twice what they make in Japan. This year, they're saying that they're expected to bring in a total of 46 trillion yen, 47 on the tax and supplemental side. And they're probably going to spend, with the current stimulus number, about 102 trillion. They're probably going to up that number in either April or June. Just think about what's going on. They're spending more than twice what they make 5 years in a row. This is just a busy chart. I'm going to skip this one. We at Heyman tried to understand what kind of indices we could design to indicate what kind of stresses the country was really under, and we designed this finance minister index. And we have now 10 finance ministers in 5 years. We have 5 in the last 3 years. If you're just to take a step back and you see the quantitative analysis that I go through is, in my opinion, is irrefutable. You can't even argue the numbers that I give you because the numbers are the numbers. What you can argue are the qualitative perceptions of the participants and how they're likely to act going forward. I think that's the question up for debate. And when you take a few steps back and you realize each data point that I'm going to give you tonight, if you're to write them all on a wall, the proverbial writing is all on the wall. It's the most obvious scenario I've ever seen in my entire adult life. It's just a question of when. When does some qualitative input change the participant's behavior? Because when that switch is flipped, it happens all at once. The demographics are the most important thing, in my opinion. When you look at the U.S., and you know, Austin being where he was, we've had several spirited discussions about this. We can't pay for Medicare, A through D, and Social Security. Come on, we all know this, right? This is a fact. It's how we change it and how we kind of abrogate whatever implicit or explicit contracts we have with the people. How we do that going forward is something that is, I guess, up for debate. But what did Madoff teach us? Like, Madoff taught us something really important. You can make promises ad infinitum of future benefits to people as long as you have one thing, right? As long as you have more dummies entering the scheme than exiting. It's really that simple, right? As soon as that relationship changes, the gig's up. Well, we in the U.S. still have population growth. We still have more people entering the workforce than exiting. The people in D.C. can keep doing what they're doing, right? There's no consequence for fiscal profligacy as long as that one relationship exists. In Japan, that's changed. So these are numbers that basically say they had about 127.9 million people at the peak. Now they're down to about 125 million people. You're going to have a mass problem with the finances of the country when you have more people exiting the workforce than entering, and that's happening right now. So when you look at over a third of the population is over the age of 60 and 25% is over the age of 65, and in the developed world that number is around 8%. You have a problem with a xenophobic society. I know Anil and I, sorry, good Lord. I didn't mean to butcher you there. That might be the worst word, Austin. I'm going to get written up in the post. You know, one of the things that I forgot where I was. Yeah, we'll talk about it over dinner. One of the things that's going on in Japan today is the elderly are keeping big stacks of cash by their bedside. When they have severe stress and have to call for an ambulance, the ambulances are driving around town until they die. They have to pay off the ambulance drivers to get them to the hospital these days. One thing that's happening, if I were right about the population decline, last year, so 2 years ago, we said they'd sell more. I think in August or September. This is an adult diaper fashion show that they were holding over in Japan. Again, the key here is, if we're right about the demographics turning, the largest buyers of their debt are, so when you think about their debt, 95% of their debt is held internally, and 95% of that 95% is held institutionally. It's all held in just a few hands. The GPIF, the largest pension fund in the world, Japan Post Bank, the largest bank by deposits in the world, the banking system and the life cos own all the bonds. You hear that the people own all the bonds. They own all the bonds through institutions. The institutions own all the bonds. if you're right about that, or if we're right about the demographics changing the financial kind of macroprudential makeup of the country, what would you expect to see? Well, look at these press releases. Japan's giant pension fund was a net seller in fiscal year 2012. Not only did they not buy any more, they actually had to sell some. You don't have to find a marginal buyer. You have to find new buyers to buy everything that all these guys are going to sell. So what you're seeing now is an accelerated rate of central bank balance sheet expansion in Japan. These are the owners of the debt. You guys probably already know this. Again, when you look at some of these press releases, they're on the back pages of the Asian Wall Street Journal. They're not going off on CNBC with red lights pointing you to the flow chart of if this happens, you know what happens next? These press releases come and go and no one's paying attention. Again, the writing is all on the wall. It's all there. The largest owners of the bonds have to sell them now. Right at a time in which the country's running the largest fiscal deficits of any developed country in the Western world at 10.5% of GDP. What happened, if you guys remember what happened in Mexico in '95 and the tequila crisis, the wealthy Mexicans and the corporations that those wealthy Mexicans ran decided that Mexico was in an untenable position. And they started running with their pesos. They started moving them out of the country. They started acquiring Western assets external to Mexico, and they started running with the currency. And if you remember, that was the beginning of the end for the Mexican currency back in '95. What do you see happening in Japan? The largest external M&A boom in Japanese history happened in the fourth quarter of last year. You had SoftBank for Sprint for $20 billion. You had Dentsu for Aegis for another $5 billion. You had $32 billion in the fourth quarter. You had their external acquisition pace was 70% of the U.S.'s last year in an economy that's less than a third the size of the U.S. Bank of Tokyo Mitsubishi has their personal savings rate going below zero this year in the left chart. Well, that makes sense, right? If you were saving your whole life and you had to exit the workforce and start retiring, you'd start harvesting your savings, which is, again, that makes sense to me. These are all pretty easy things to understand. Get that one. I think what happens here, when you think about the psychology of this scenario, you have 20 years of the pro-cyclicality of groupthink that's manifested itself into a situation in which, think about what's happened in Japan. If you own real estate in Japan, you've lost 75% of your money. If you own any of the stocks in Japan, you've lost 75% of your money. What one asset of the Japanese people bought where they've never lost a penny, and it's their own bonds. So at a period in time in which JGBs are at their riskiest point in post-World War II history, the optionality on that asset is cheaper than it's ever been. Right? So the Black-Scholes model dramatically misprices risk at secular turning points. It's analogous to driving a race car with a rear view mirror. It's a beautiful thing, actually, if you're kind of trying to run a hedged portfolio and look at these kinds of risks. One of the things we were talking about before the speech, there's a new guard in town. We all know Kuroda took over. Here are a few of the quotes in looking at, kind of, you have Kuroda, Iwata, and Nakaso. The guy to watch is Nakaso, in my opinion. He's going to interface with the BOJ, the other BOJ members for Kuroda. He's also going to be the guy that takes Kuroda around to the various central banks around the world, and he's going to be the mouthpiece. So anything that Kuroda around to the various central banks around the world, and he's going to be the mouthpiece. So anything that he says is actually pretty relevant, and I don't know if the world's kind of figured that one out yet, but I think that, again, taking this situation, this powder keg, this enormous pile of kindling wood, and setting it ablaze or lighting the fuse is what's going to happen when these guys really start targeting 2% inflation. Central bank balance sheet expansion. This is one chart. There's another one that I didn't put in here. This one is basically the BOJ, ECB, the Fed, BOE, and PBOC. For those of you in the back, the BOJ is the one on the bottom. They're using 100 back in May of 2006 as the starting point. This is, again, some really recent quotes as to what some of the largest owners of these bonds are saying. The bottom one is really important, I think. Japan Pension Fund has too many bonds on the Abe plan. Right? That's that oh shit moment when you own, the most negatively convex instrument you can possibly put in a portfolio, and they tell you they're going to go for inflation. right? And those people are the pundits that say, but the Japanese have this cultural ability to show a love for their country by really supporting their bonds through their nationalistic tendencies or their love for their nation. And I say, don't confuse the love for your nation with the love for your government, number one. Number two, I think it's really, really important to think about. We conducted a study amongst 1,009 institutional investors in Japan. We asked them this question: in the event that Japan were to start to have a bond crisis, i.e. rates would move up 100 basis points, would you be apt to invest more because it's a much higher nominal yield, or would you be apt to go somewhere else with your money? What percentage do you think said they'd invest more? 8. 83 said they would run, not walk. So you have to realize that the first inalienable right of human nature is self-preservation, and I would say that human nature trumps cultural norms 100% of the time. This is the EC, this is the BOJ balance sheet. How many times have you heard this one in the marketplace that this market that we've been studying for years? I hear, well, they can't have a problem with their financing because they run current account surpluses and they can internally fund themselves. Well, how many times have you heard that statement that as long as they run a current account surplus, they can fund themselves? There's naivete in the statement because if you're not taking into account the amplitude of the current account surplus vis-a-vis the fiscal deficit, well, then you're doing yourself a disservice. Needless to say, when you're running a current account surplus of 0.5% and a fiscal deficit of 11, it's just not true. And when you look at the size of the central bank balance sheet and the expansion, that statement becomes axiomatic through induction. It's kind of the way the human psyche works. Just like U.S. home prices can never go down because you start saying it enough, you start to believe it. That's what's happening in Japan, and that's just patently false. I think they're starting to show you a little bit of stress. They're starting to advertise government bonds in taxi cabs. From the Ministry of Finance's website, you have the #1 sumo wrestler in Japan and the worst girl band in the history of man being hired to try to sell bonds to unsuspecting Japanese businessmen. We recently, on the MOF website, they had kind of a Q&A for investors, and this is Google Translate, so pardon the translation. But it said, if Japan has a financial collapse, how will the government handle government bonds? And the answer is, government bonds will be redeemed because the government is responsible for them. Please don't worry. We can get into the bottom line on the balance of trade. What's happening is the current account's going negative. So not only is it not slightly positive anymore, it's negative. A few things are contributing to that. Prior to the earthquake and the tsunami, Japan did a couple of things that were strange, that they've completely disrupted the supply chain going forward. One is they sole sourced a lot of their auto parts and electronics parts for their industry within Japan. And when the tsunami hit, they had to go source in other ASEAN nations. They completely changed their supply chain. Well, that's a secular change. They're not going to sole source back in Japan again. That's one. Two, as you know, 31% of their baseload power was generated by nukes. Well, those are off now, and Japan has no natural resources. They have to bring everything in, and they're desperately trying to secure long-term natural resources for crude oil and natural gas and coal and things like that, which really affected their balance of trade. So something that was a pretty significant contributor to a positive current account has actually swung them in current account negativity. On top of that, the Sengaku crisis is happening. And in the Sengaku crisis, what you're seeing is the Chinese are informally boycotting Japan by both the Chinese SOEs, the state-owned enterprises, and Chinese private sector. They're not buying Japanese goods. And what's interesting about that is, this fight over the Sengakus is really a fight over not the rocks and the islands. It's a fight over the natural resources on the seabed. And that's why China cares so much about it, and that's why Japan won't let up. This is out of Wall Street Journal. Look at what auto sales did on the back end of this first resurgence of nationalism. So Japanese exports to China have grown 90% over the last decade. They've dropped 34% in Europe, 31% in the U.S. This is a very functionally relevant relationship for Japan, and we think that number's been cut in half. That's 20% of Japanese exports go to China, and that number's dropped by 50% in a few months, and that's secular. All of a sudden, Abe is not going to wake up and love China tomorrow, and China is not going to wake up and love Japan tomorrow. So again, all of these things are secular changes in their balance of trade that are really affecting them. We'll skip that one. To put things into perspective for those people that might think this is cyclical or this is going to change, this is the simple balance of trade back to 1960. It doesn't look too cyclical to me. This is a secular problem. It's dragging the current account by almost 2 full points of GDP. We think the current account will be negative, well, as the last couple months, if you've seen, in the next quarter or so it will. The J curve will help it on the back end of this currency weakening move, but it will only slow down the secular decline. It won't reverse it, in my opinion. Japanese industry has been hollowed out over the last 20 years. When you start to think about signs of stress, what would you expect to see? What we monitor the swaps marketplace, we monitor cash rates. Swaps are more interesting to us. We also think about spreads, because if you were to forget about Japan for a second, and I were to just draw a generic picture of a country for you, if I were to tell you their GDP is dropping at an annualized nominal rate of about 3.5%, and I were to tell you that they're entering a severe recession, how would you draw their yield curve? Well, I would assume you'd draw an inverted yield curve. But then I caveat that by saying they have a zero lower bound. Then what will you do? Well, you just draw it flat across the zero bound. Well, what's interesting is it's not flat. And the spread here between 10 and 30 years is actually showing me some interesting signs of stress already. This should be closer to zero and not at 20-year highs. So you're already starting to see signs of stress on the back end of the curve. They're still pegging the front end, but the back end is kind of flapping in the wind. For those that think the move in the yen has been huge, this is the yen that goes back to the early 1970s. The move so far is pretty small. If I'm right about what's going to happen here, we think the yen really moves, let's say north of 250, and we think rates go into the teens in a full bond crisis. So far, cash bonds are not paying attention. So what you've seen so far with this kind of this new thought that Abenomics and the new central bank governor and his regime can really get Japan to 2% inflation. The currency speculators believe that it is a big change in the manner in which the way the administration is working. Most importantly, there's no natural currency purchasing mechanism now that their current account's negative. So I think that the bond market's not telling us, this is the 5-year rate. Bond market's not telling us anything yet, but when things move, they'll move all at once. You know what my conclusion is here. So I kind of skipped over a whole bunch of things because I had 25 minutes, but I'd love to entertain some Q&A now, and I think there's a mic and someone running, a couple people running around with microphones. All right. Austin, you're the only one that can ask.
Carl, thanks for coming. So let's assume that your assumptions are right and Japan will crash around 15. What does it mean for the world and other players like China? Now there are 3 main countries with surplus: Germany, China, and Japan, right? And that has to be absorbed somewhere. So now China is facing the same problem that Japan was facing 20 years ago, and Japan's solution was just to have the government, assume that the debt that the private sectors was entering. So we'll see China not being able to balance the accounts because of Japan collapsing, and we'll see the same scenario happens in maybe 15 years for China.
Yeah, it's a good question. I think that, so first of all, there are financial implications to us being right, and there are social implications to us being right. If we're right about Japan, the social fabric of that region will be torn. And, if you kind of follow historical precedent, it just means that there'll be a war between someone, and it's just not going to be good. I don't know between who and who. I have my own guesses, but I'll leave those out. But I think that when you look at China, China's been this move from being an export machine to fixed asset investment and carrying the world along with it. From the financial crisis, their banking system has expanded 50% of GDP 3 years in a row. You think about in the last 2 years, if the U.S. lent $16 trillion to our banks into our economy, I'd bet the over for 8% nominal growth for all you wanted to bet. Right? So, and they're still having trouble getting the 7.5%. Their banking system is 350% of GDP. Their NPLs are sub 1% in China. Their average NPLs over the last 20 years have been about 19, and in periods of stress, it's been about 35. You just do back math. That magic pile of money that China has, the $3.5 trillion of FX reserves, I just don't even think it's there. I mean, it really, if the NPLs show up and the banks are going to have to recap their whole banking system. Now, can they throw another turn of GDP into the banking system? Yep. Do I have any idea of when and how they're going to do it? Nope. We have no investments there. But I think China's, a bug in search of a windshield as well. I just don't know when. But again, look, there are consequences to this kind of fiscal profligacy that everyone's engaging in, and I think that in extremis, it's Japan, and Japan will be the first one to go. My hope is that our policymakers have front row seats to how this all ends, and maybe it changes their modus operandi, because nothing's going to change it, barring something like this. Oh, that's coming. It's coming.
Japan holds a fair amount of treasuries. What happens to that holding on the right side of the balance sheet when all this stuff happens?
It's a good question. So they have about $990 billion of U.S. treasuries as a asset of the government, right, with their FX reserves. And so I kind of think about this in a couple different ways. First of all, the two largest contributors to the IMF happen to be the two largest debtor nations in the world. It's an interesting stat. There is no lender of last resort for Japan, right? The IMF was designed to kind of help really small nations with balance of payments problems. It wasn't even thought of to even make medium-sized loans to bail out countries like it's trying to do now. So I kind of think it as dip loan money. If you have $990 billion worth of U.S. treasuries, you better hang on to it. Austin and I were talking beforehand. If you want to go spend it and try and hang on for a little longer, pre-problem or bond crisis in Japan, I'll just put it into context. Let's assume you had an entity that was willing to swap Japan $990 billion worth of yen for those treasuries. So there'd be, basically what I'm saying is, let's take out FX movement, let's take out rates movement in the U.S., let's just assume someone swaps them. That wouldn't fund their fiscal deficit for more than 18 months. Then what? It's analogous to selling the family silver or running up credit card debt. It wouldn't engender confidence, I can promise you that. But I do think that they do have a couple of assets on the balance sheet, and they're going to need those when the times get tough. So if I were them, I'd hang on.
If tomorrow you got put in charge of Japan, what would you do?
I'd quit. Yeah, I think they're already in the zone of insolvency. There's nothing you can do. I mean, as you saw, the last 10 finance ministers, one guy actually killed himself, Nakagawa, and then the guy that took over after him, after ratifying the 2011 budget, checked himself into a hospital and literally had a press release that said it was after ratifying the budget, I literally was overcome with anxiety. I mean, you don't see 10 finance ministers in 5 years unless there are real problems. There's nothing they can do. What I worry about is, I think that these people are going to lose so much of their purchasing power at the wrong period of time in their lives, given the age of the population, that again, it's going to tear the social fabric of the country. There's nothing they can do, in my opinion.
You spoke a little bit about the swaps market. What is it specifically that you're looking for that would possibly be the trigger to turn the JGBs and turn the bond market?
Yeah, I think that if and when the swaps marketplace believes that they can get to 2% inflation, that blows the bond market up. So I guess the swaps will lead everything else, in my opinion. And so we follow those carefully every night across the curve. So far, no one believes it. But the key is as soon as they move, it's too late. You won't be able to get involved. And so right now, it's just something we're monitoring. Here we go. Sorry about that.
So
Do you think the capital markets can attack both Japan and Europe simultaneously? And how long do you think Europe's going to be in the dumps?
The chronology of events is really important. So if and when the Japanese situation materializes, I think that U.S. and Japanese nominal rates will go negative. And that'll be the time to make the bet against the U.S. and Germany on the rates perspective, but not now. With Europe, they've fixed nothing, right? When you look at the manner in which we're positioned, we own some special situation assets in the U.S., and all of our hedges are with European equity, because I think that's also something that's likely to come. We don't know when, but I don't have a great answer for can it happen simultaneously. I guess not, and if it does, our rates will really go negative for a short period of time. But I think Japan happens first. Yeah.
Do you have a forecast for Japanese equities, particularly the Nikkei index?
Yeah, I think that there are two ways to think about that, and this is the economist one hand on the other hand, but there are kind of two precedents that I think about. One is the tequila crisis in Mexico in '95. Right? They devalued their currency roughly 60% overnight after many affirmations that they wouldn't devalue it. They just did because they had to. And in theory, if you devalue your currency 60%, what should happen to your equity market in nominal terms? It should take off, right? What happened in Mexico? Their equities dropped 70% in 40 days. So you lost 60 in the currency and 70 in the stocks when that happened. Again, the other side of the coin is, if you boil the frog slowly, he doesn't know he's getting boiled, and that's Zimbabwe. So the Zimbabwean equity market, as they dialed up inflation, you were really doing well in your stock market portfolio, and your portfolio did really well, and then after 10 years, you tried to harvest it, and you could buy 3 eggs with the money because you weren't paying attention to real rates of return. Both of those scenarios I think when it's a shock, equities don't do well. And the people that own Japanese equities today, in my opinion, are kind of macro tourists. They think, cheaper yen, buy stocks. They don't realize Japanese industry has been hollowed out. Some of the companies will do a little bit better, but some of them are not going to do any better, and it's not going to change the secular trend. So I think it's kind of analogous to picking up a dime in front of a bulldozer. I think it's a pretty scary thing for me is to be long Japanese equities right now. It's not to say it won't work for another 20% or 30% or whatever the number is. It won't, not with my money there, it won't.
For a retail investor, how would you profit from Japan's fall?
I don't really have a good one for you there. The instruments available to retail investors are just they're not there, and not knowing your personal financial situation. If you have $100 million in ISDAs and Quib letters, well then we can talk. But if you don't, it's just too much of a problem. I mean, the convexity is not there for you, is what I'm telling you, unfortunately.
So a world that sees Japan fail, it's a very different qualitatively world than it is right now. I'm kind of wondering what's the next domino, and what does it do to really investment strategies in the future?
Yeah, if I had that crystal ball, I wouldn't be standing up here. And I worry about these things all the time because we all live in this world. I really hope I'm wrong. I'm only spending a little bit of money every year making sure this hedge position is on there. If I'm wrong and nominal growth is there and we don't have any problems and there's no consequences for fiscal profligacy and we live in Krugman's world, just sign me up. Unfortunately, ignorance would be bliss in that world. I tend to think that there are going to be consequences. They're going to be soon. And, the domino effects are important. The best time in the world to invest in Japan is afterwards, right? When currencies typically overshoot because they discount the PV of the rates curve going forward, which won't be that way after a restructuring. So currencies get too cheap, stocks get too cheap, and that's when you move your money in. So you just have to have a plan, and I think the plan is to be my personal plan is just to be rational about all of this. Don't believe anything that all these people are telling you that run central banks, because they'll never tell you the truth until it's too late. You know, if you remember when Juncker was interviewed in 2011, that one of the heads of the European Financial Council. I don't know if you remember this quote, but the press went and asked him and said, "We heard there's a special meeting to discuss Greece's restructuring, kind of May 2011. This is before Greece restructured their bonds." And he said, "Oh no, there was no meeting. I don't know what you're talking about." And then they went to a couple other finance ministers and said, "You know, what happened in the meeting?" He said, "Oh, we talked about Greece and this, and Juncker was there." And they went back to Juncker and they said, "What you told us that there wasn't a meeting, and these other two guys just said you were in the meeting." And he said, "Look, when things become serious, you just have to lie." You can go look this up. This is a quote. This is a quote. But again, the Mexican government told you the day before they devalued 60%, they said, "We will not default, we will not devalue." Then the next day you woke up, they said, "Well, we just had to." They're never going to tell you this is coming. You have to just make these determinations on your own and, you know, protect yourself from it. Own physical assets that are productive, and that's the only way to kind of save yourself from the stupidity of these people. Any more?
You know, Japan had all these great things you talk about, you know, over the past 20 years. They had this current account surplus. I know recently it's gone down, but in America we're running a $65 billion a month, you know, trade deficit. If a situation happens where the dominoes start to fall, relative to how Japan will work, how will the U.S. turn out?
I think they go much lower in that environment because of this Pavlovian response to safety, not as an endorsement of our fiscal policy or our greatness in legislative success. I think our rates go lower. When I go to D.C., and I'm sure Austin had the same experience, you meet with people on Senate Banking, House Financial Services Committee, the guys that are really the key policymakers, and you start talking to them about, hey, you've got to start changing the way you're doing things. We need to be thoughtful about this. And they say, well, where are 10-year rates? And then you say 180, and they say, well, I don't see a crisis. And yeah, but right now they're saying they're using the bond market as their barometer for crisis. You know, and again, you know, that would really lead you to make some really bad investments throughout your life if you use the barometer that was a coincident or lagging indicator. So I think the U.S. is on a terrible path. Our debts are 5 times our central government tax revenue. We're not in the zone of insolvency yet if we're willing to, you know, restructure Medicare through D and Social Security. And look, I'm a fan of restructuring those and raising taxes. I'm probably upsetting the whole room by saying that, but it's what you have to do. But, you know, come on, there's no impetus to do that. So we're on the same path, and we're just years behind. We also have the biggest blue water navy. That's a good thing.
So there are unusual high volume in CME Group dollar-denominated Nikkei futures. So does that mean that this can be a really good instrument for investors to capitalize?
I think that's prima facie evidence of macro tourists, right? It's a whole bunch of equity crossover accounts in the U.S. and macro players that have this Pavlovian response to, oh, weekend buy stocks. You know, that's perfect evidence of my point, my opinion.
So I read with a little bit of irony the G7 and the rich countries, and everybody's broke except Canada, maybe. So what? It seems to me that the big problem is expectations of the people. And isn't there, because you theoretically could communicate to the people and change what they get for what they give, that it sounds like Japan is way beyond the brink. But what about other countries? I mean, isn't that really what this boils down to? Is entitlements versus, you know, the rules have changed and our government's a shambles or our finances a shambles?
Yeah, I mean, I think as long as you have population growth and kind of net new people coming into the system, you can make those promises and don't have to live up to them. It's kind of really simple. When you get into a scenario in which you have a secular decline in population, kind of the rubber meets the road and you blow apart. We have years before that happens here. But look, the debt stock only matters when it's untenable, and I don't think it's untenable in the U.S. today, unless you want to bring on balance sheet the contingent liabilities, which we can change. But who's going to change them? Here's a great story. With Medicare D, right? This is the Republicans' way that they got Bush a second term, right? Karl Rove sat in a room and he said, "We need to buy the votes of the elderly." Well, we just need to give them free drugs. And so they said, his economic council stood up, two of the guys did, and said, "But you can never pay for it. It's going to cost 1.4% of GDP for eternity, and you can never pay for it." And he said, "Sit down. We need these votes." And so that's how Medicare D got passed. And then I asked Carl last year in a kind of a public forum. I said, I got to ask the first question. I was like Horseshack in Welcome Back Cotter's class. I was like, oh, you pick me. And I said, so was Medicare D a good idea? Looking back, and he shifted in his chair 3 or 4 times. And he said, well, 3 things happened with that. The first was, the actuaries really missed the number of people that would sign up. And I said, for free drugs, how could they possibly miss that? And then he said, and the second thing they missed was the rapidity at which they were going to sign up. And I said, and then the room was laughing so hard no one heard the third thing. But that's how laws get passed. That's how Medicare D, it wasn't the benevolence of Karl Rove. It was Karl Rove buying votes. And so as a politician, whether you're Obama or whoever else is next, if you endeavor to change free drugs for everyone, you lose. So you just can't do it. That's the reality of the situation. So we're just going to we should make Krugman president, and we'll just keep spending until things go poorly.
To what extent the sort of crisis element of the scenario be blunted if the government of Japan liberalizes immigration, prints the money, cuts spending and raises taxes?
I love that one. And then monkeys fly out of where. I mean, come on. It's all be unicorns and rainbows. And again, I want to live in that world. Unfortunately, I don't, but I'd like to live in. I mean, they're the most xenophobic society in the world. They're the most homogenized society in the world. Of 125 million people, less than 3 million are non-Japanese. They hate the Koreans. They hate the Chinese. There is no love lost between anyone over there. And for immigration reform, I don't know who you're going to invite in, and I don't know how you're going to get them to. And if you do, what's going to happen to wages? I mean, from what I'm reading, we need wage inflation. That isn't going to encourage wage inflation. It's an untenable scenario. I just don't think it can be fixed. Maybe I'm just too apoplectic about this scenario. I don't know. Any more?
Kyle, when you look today in the capital markets at the tactical asymmetry that exists among the various financial instruments to take advantage of the cheap optionality, what is that instrument? And number 2, you referenced the fact that you would own the right physical assets. And what would be those right physical assets to own?
Yeah, I mean, like apartments, oil wells, things that are productive assets, and then, operating businesses that have a little bit of fixed leverage are probably something that is going to do well. As far as the instruments are concerned, I'll give you guys a little bit of an idea. So we don't talk about exactly where we are, what we do. We tell you how much we love Coke, but we're not going to give you the formula to build it to make it. But I think the AIG of the world is back, and here's what I mean by that. I have 27-year-old kids selling me 1-year jump risk in Japan for less than 1 basis point. $5 billion worth at a time. You know why? Because it's outside of a 95% VAR. It's less than 1 year to maturity. So guess what the regulatory capital hit is for the bank? It rhymes with hero. Right? And if the bell tolls at the end of the year, the 27-year-old kid gets a bonus. And if he blows the bank to smithereens, he got a paycheck all year. We're right back there. I mean, the brevity of financial memory is only about 2 years. And I wouldn't sell nuclear holocaust risk in Dallas for less than a basis point. Right? you should be fired for thinking about selling something for less than 50 basis points. You know, and yet this is happening again. And it's happening in huge size. You know, huge. We bought $500 billion worth of these options. And interestingly enough, recently, one of the biggest banks in the world called me and asked me if I'd close my position. Well, that was an interesting day for us. That happened to me in 2007, right before the mortgages cracked. But they said, you know, we ran some new risk tests. And I said, really? And they said, yeah, you know, our new stress scenario is a little bit more punitive than the last one. And I said, well, what is it? And he says, we don't want to share, you know, our proprietary secrets of our bank with you. And I said, okay, well, I'm not closing it. And they said, whoa. How about, you know, our old one had rates being stressed 50 basis points, and the new one has rates being stressed 400. And I said, well, yeah, 400, that would really hurt you in this trade, wouldn't it? And they said, yeah, we'd like to close that one. And I said, well, I'd like to, but I'm not going to do that for you, so I'm sorry, you know. But anyway, they're starting to realize that why would they run a stress test like that? Well, who would have them run that stress test? This is happening. I think there was one more. Was there one more?
I'm not sure you're going to like this question, but it's very simple. What are you buying? Gold or guns or both or neither?
Austin and I blew up a beaver dam together, actually. It's a great day in Texas history. The beavers were safe, I think. Look, again, I don't get paid to be an optimist. I don't get paid to be a pessimist either. I just get paid to be a realist, and I want to be a prudent fiduciary of the capital. That's all I care about. And then I tend to care about social issues in the world. And if I'm right, the social issues are going to be really difficult. Do I think things are going to spin out of control into anarchy and a need for guns? No. Do I think the payment systems will still function? I do. I just think what they're going to pay you with it's going to be wampum, but it's still going to work. And you know, it's going to be a scenario where things are just a little bit tougher. You know, we've gone through a scenario where things got tough, and now all of a sudden there are 1,400 new billionaires. So maybe the capital is misallocated, Austin. I don't know. But I think going forward, things are just going to be a little tougher. And I don't think you have to go buy guns. If you asked me, if I had to buy one, so the retail investor in the back, this is a good one. If you asked me which one investment would you make for the next 10 years and just go to the beach and go spearfishing for 10 years, which I love doing, I would buy gold and yen and just go to sleep. Right? I'd sell yen, buy gold, go to sleep, and wake up 10 years later and you'll be fine. Right? But don't do that with all your money. And, you know, put a little bit of that on if you want to, but I think that's the single best investment you can make today if you're just trying to make one. All right, thank you. Thank you very much.